Alright, in this video we'll do a slightly more complicated example of deferred tax assets and deferred tax liabilities. Alright, let's look at Lando Corporation. They have the following information related to their first year of operation, which is 2013. So we have their tax depreciation. Remember, the IRS uses a different depreciation system. So under the tax depreciation is $40,000 more than the book depreciation or US GAAP depreciation. And this difference is going to reverse equally over the next, let's see, 2014, 15, 16, 17, the next 4 years, okay? Another important piece of information is that Lando received rent payment of $20,000, but that rent is unearned. The rent revenue from that will be earned in the year 2014, which is the following year. Pre-tax book income for the year is $300,000, and the tax rate for all years is 40%. So, what is taxable income for the year 2013? Just remember our big picture here with the 4 boxes. They have given us one box. They have given us pre-tax book income is $300,000. So from that one box, I can already figure out income tax expense, can't I? I take the $300,000 times the tax rate of 40%. Would be $120,000. I already can get the box below it. But this is crucial here. I need to take that and I need to convert it to taxable income to get the other box over there. This is the key here. So how am I going to do that? Well, let's see. We'll begin with pre-tax book income. That's something we know, $300,000. And let's convert it to taxable income under the Internal Revenue Code. So if tax depreciation is $40,000 more than the book depreciation, what should I do then to convert this to taxable income? Should I add $40,000 or subtract $40,000? Pause it and think about it. Answer, you should subtract it. The depreciation is more under tax code, so I take my book income, I gotta subtract 40 more. All right, other difference here, the rent payment. So basically, we did not record any revenue under US GAAP from that $20,000 payment, but the IRS says yes, you will have to record that. So should I be adding or subtracting that $20,000? Pause it and try to answer. All right, you should be adding it. Now, I'm writing DTL and DTA next to these. The depreciation gives rise to a DTL. All right, so DTL, deferred tax liability, that means you're deferring paying taxes. You are basically, it's good right now, right? The taxable depreciation is more, so we're saving extra money there. We get to subtract a higher number from our income tax report. But we're going to have to catch up later. It says this will reverse equally over the next 4 years. DTA, deferred tax asset, is the opposite situation. We are basically paying taxes now on this $20,000 payment, and we're not getting to recognize any revenue. But what that means, though, is that the next year when we do recognize $20,000 in revenue, that's going to be $20,000 in revenue that we're not going to be paying any taxes on. So that's good. That's an asset, a deferred tax asset. Anyhow, the net difference here, starting at 300 minus 40 plus 20, taxable income is $280,000. All right. So, Part B, what is going to be the journal entry to record income tax expense and income taxes payable? Well, all right, all you do is you say, okay, income tax expense, 300,000 times 40%, 120. Easy. debit. Income tax expense, debit 120. The credit, take your taxes payable here of 280 and multiply it by 40%, which is the tax rate. That's income taxes payable. It's a credit. These little guys are going to be the differences there. And let's see how that works. So you see how that goes? Income tax expense, as we said. Income taxes payable. The differences are DTA and DTL, and do not lump them together. They are different. Got to record them separately. But your DTA is take the $20,000 times the tax rate. You have a deferred tax asset of $8,000, which makes sense, right? The next $20,000 you earn, you don't have to pay taxes on it. So what's the value of that? Well, the value with a 40% tax rate is $8,000. That's why we multiply it by a tax rate. Same thing for the deferred tax liability. Its value is $16,000 because it's $40,000. The next $40,000 of depreciation will actually be lower under the IRS code, so you'll have to be paying more on that tax-wise times 40%. That is the whole journal entry there. All right, let's go to the next year. Same company, Lando Corporation, same details. It's now 2014. Let's do the journal entry, assuming that taxable income is $325. The tax rate is still that 40%, remember? Still sitting at 40%. So income taxes payable is easy. $325 times 40%. That's income taxes payable. But they did not give us pre-tax book income or GAAP income there. How are we going to get that? Well, let's start with 325 and let's convert it. The only thing I know for sure, if I'm going back to the last slide here, the only thing I know is that this detail here, the difference in depreciation is going to reverse equally over the next 4 years. So $40,000 reversing equally over the next 10 years, that's $10,000, $10K per year. All right. So the money collected last year generated that deferred tax. Oh, that's the other thing we know. I almost forgot the other detail. That rent payment. That's right. We received a rent payment of $20,000. The rent revenue will actually be earned in 2014. Okay. So you get two things reversing, right? So whatever you did previously, you got to kind of undo it. So if you look at what we did previously, you see here, we added, okay. Let's see how this goes. This is where we stand right now, based on what happened last year. Now, this whole thing is going to reverse this year, basically, for the revenue, the rent revenue. This entire thing will not reverse, but it will partially reverse, 1/4 of it. Take the 10,000 times 40%. All right. So this is what the complete journal entry will look like right there. Okay. So you see that income tax is payable, $325 times the tax rate, the DTA there, the DTL, again 1/4 of it, and you can just kind of back solve. You can plug it in to get the income tax expense. Okay. I think that's enough for this video.